what's the consensus? Bullish, bearish on gold? What do we think right now?
Kind of seems like there's a bit of an ascending triangle there, and that it would have broken through the top, doesn't it? I don't know. So I'd say probably bullish in the short term, just based on that.
So for those of you wondering what he's on about, are we talking about this type of this sort of triangle here? That
like
being
that.
the top. And then kind of if you draw it from this low here. So breaking out the top of this thing, something like that. Okay, yeah. So bullish because we're breaking out of a triangle, and often that does lead to a bit of a up leg when the market's been consolidating in a relatively tight range and is getting tighter and tighter and tighter, and then breaks out of that range. It often has a bit of an impulsive move. Yep. Okay. So if you wanted to be long gold and you wanted to do it via options expiring in a couple of months, what kind of structures would you be looking at? So the market's at 1850 right now, or 1855, 1860, something like that, okay? So what do we think? If you thought the next 2 months gold's going to 2000,
probably some type of call spread.
Okay. Okay, so immediately you went to a call spread rather than a call. So what's your rationale there?
If I kind of got the target, if you said the target price of 2000,
yeah,
I'll short the call at 2000 and then buy it at whatever.
What if that call wasn't worth anything?
Then I'd have to buy close to the money call.
Yeah, I'm saying that call that you want to sell at 2000.
Yeah.
What if you didn't get anything for it? Would you still sell it?
No.
Right. So before you decide to buy a call spread rather than a call, check the pricing, right? Because you might then find that actually I'm selling out that 2000 call for pittance. I might as well not bother. Yeah.
Yeah.
Yeah. So, but yeah, okay. So, but you're thinking along the right lines. Anyone else? Any other ways to be bullish?
I'd say maybe just buy like an out of the money call. It'll be cheap.
So out of the money call, like what sort of strike?
I don't know, maybe like 2-2 or something. Just make some money on the premium if it goes up.
2-2. Wow, that's miles away. Okay, interesting. All right. Well, we can investigate. We can look at the pricing of all these things and then have a think about the pros and cons. Any other ways to be bullish?
You could sell a put, I guess.
Sell a put, yeah. I was wondering who was going to say that. Yeah, that's always an option. But let's have a look then. Let's see what we think. But basically, we had this triangle. We took out 1830 was kind of probably the top of that channel, and we've done a quick move up to 1860. Okay, and we are now targeting range somewhere between the 1900 and the 2000 range potentially. Okay, let's say that's the scenario we're trying to play. So now let's look at the gold options. So the gold options are here. So there's various expiries you can use, but now the one they're calling August actually expires on the 28th of July, which is in 6 days. So we won't bother with that. The next one, which they call October, expires on the 24th of September. That's pretty much a 2-month option, okay? And then we can look here. So the at the money option, right? So like let's call it the 1870 strike, costs like the two-way on the calls is 51.2 at 52.7. Okay. So who wants to tell me what the break even is? If I was to buy that thing at 52.8, what's my break even on the upside? Where do I actually start making money?
$1870 plus 53 in this case.
Which is?
19,
basic mental arithmetic.
1922, 23.
Yeah. 1923. Okay. So that's where you'll start making money if you just hold that to expiry. You need it above. You need it above 1923. Okay. And we were saying that. Sorry.
You need to account for the spread.
Well, you already have accounted for the spread because you said 53 is what you're paying, right?
Okay.
If you're buying it, you're paying 53. If you're selling it, then you're selling 51.8, right? Okay. So can you guys see that, by the way?
Yeah.
Can you see the area where these options are? This bit here. See that? Okay. So that's the at the money option, yeah. But that's where the at the money option is. So, and we said that if our target was around 2,000, maybe, let's call that our best case for rally in the next 2 months. So you're basically saying your break even is 1923, you're spending 53, and if we get to 2,000, you're making around 77 points, basically, right? So you're making 77 and you're spending 53, okay? So if you think of your risk reward, that's kind of your risk reward, right? 1.5 to 1 or something, okay? So on that, maybe we're thinking that risk reward isn't that amazing. I want a bit higher risk reward on that. So what are my options? I could do a call spread, yeah? I could buy maybe a more out of the money call to get better leverage, to buy a cheaper premium call so that my initial outlay is much less, yeah? So like, same story, if we bought the 1950 calls, yeah, they will cost how much?
28.3.
28.3. So then if we go to 2,000, you're going to make 50, having spent 28. Again, kind of even money sort of payoff. So if your target is 2,000 over the next 2 months, these are looking like even money to slightly better than even money if you just buy the outright calls. Okay. So maybe that, I don't know if that, maybe that's not good enough, right? So what could we do? Yeah, those. So then look at the call spreads. Which call spread could we look at? So what if we did the 1900 call spread, 1900, 2000 call spread? What does that cost?
About 24.
You pay 42 for that one.
Yeah.
And you get 18 back for that one. 24, yeah? So you pay 24, and what's the most you can make? $1900, 2000 call spread. What's the max payout of that call spread?
76.
Yeah, so the payout of the call spread is 100, right? So the profit
76 is the max you can make.
Max profit is payout, which is 100, minus cost, which is 24. So you can make 76 and your outlay was 24. So that sounds more like a 3 to 1 to me, right? Right? Or maybe a bit better than 3 to 1, right? So now by doing the call spread, our payoff, our risk reward is looking much better, yeah? So why do we think that is? Well, look at the implied vol, right? And we haven't talked too much about implied vol yet, but you're paying 17.6 implied vol on this one, and you're getting 19.8 implied vol back on that one. So the upside vol on gold trades at a premium to the at the money vol, right? Or the closer. So you're actually getting an advantage of selling that out of the money stuff because it's quite expensive, right? And because of that, you're selling the expensive thing, you're getting a nice cheap structure where you like the risk reward of that structure. Okay. Now let's look at Alex's crazy option. Yeah. The 22 area. If you bought the 2200 calls and you paid 5 for them, 5.4 for them. Yeah. If we go to 2000, does that help us?
No.
No. Okay. What if we go to 2000 in a week? What do you think happens then?
Probably because implied vol would spike a lot.
So option value will increase to maybe say 10 or 12. So we can just get rid of them.
So 2000 is a 150 point rally basically from here, yeah?
Yeah.
So if we think 150 point rally, So why don't we just look at what strike, the strike that is 150 points closer to us than the 2200. So if we look at the 2050 strike, yeah, what is that worth right now? 12 to 13,
12
exactly
to
what Ali
13.
said, right? So the strike that's 150 ticks closer to us, the premium of that strike is a good indication of where the premium will be if we were to rally 150 points and all things remain equal, right? It doesn't factor in the passage of time, so it doesn't factor in the time decay. It doesn't factor in any implied vol moves or anything like that. So there are other moving parts, but as a really quick and dirty starting point to get a guess of what it's going to be worth, you could just look at that 2050 and say, yeah, that's worth 12, 13. So if I pay 5 for this and we get a fast 150 point rally, then I'm pretty much going to make nearly 3 times my money. Okay, right? So the only way you can make money off the 22 is if you actually sell the thing, right? And actually bank that money, right? So when the premium of it goes from 5 to something much bigger than 5, you need to bang it out and take your money. If you sit around waiting till expiry, it may well go back to 0 and be worthless, right? Whereas in the previous examples, we were thinking of the options in terms of what's the final payout at expiry and what am I comfortable with, right? But you can trade way, way, way out of the money stuff with the view that you're not going to hang on to it till expiry, but you're just going to use the optionality of it, right? You're just going to use the premium of it. And when that premium multiplies, you're going to get out, okay? So that's another way of kind of thinking about that, yeah? And then, and then what about selling puts? Any puts worth selling? You know, I guess we could look at the chart and say, you know, where are the support levels? Where do you think the line in the sand is? That sort of thing. But, you know, in general, I think it's a bit risky selling puts just because the whole world is long gold, right? Everyone's been buying it. It's probably quite a crowded long. If for some reason you start to see some unwinding, who knows how deep the correction can be? We saw the correction in March in gold. It was brutal, right? So I think selling puts when the vol's only at 16, if you look at these puts, the vol's on a 16 handle, doesn't feel like a no-brainer to be doing that, right? Probably contains a lot more risk than you want to take on, I think. Yeah. All right, so out of all those options, like what are people's favorite options? What would you want to do? Who likes the call spread? Hands up if you like the call spreads. Quite a few.
I guess.
So it looks like call spread wins it, yeah? What about you, Alex? What do you like? The teenies?
Yeah, I like to play with the premium, but
You like the low delta stuff? Okay. The thing about the low delta stuff is that it can give you a lot of leverage, right? One thing you need to be aware of on the call spread, yeah, is the leverage that you're getting on the call spread of 3-1 is quite seductive, right? It sounds good. It sounds great. The optics of it are really good. But the truth is, if you get a 100-point rally quickly up to your top strike right now, the call spread is going to be worth nothing close to 100, right? That call spread's value is only going to hit 100 at expiry, right? Or if you smash through so far that both strikes are like a distant memory, basically, okay? But the truth is the evolution of the premium of that call spread isn't gonna be that attractive. That's where Alex's trade outperforms. When you get a sharp, fast spike and implied vol goes bid and you get this crazy move, right? He will be able to monetize his option, right? He will be able to pay 5 for something that is worth 15, 20, 25, whatever, has made 5 times its money, and he'll be able to bang it out and sell it and be able to monetize it, okay? Problem with the call spread is you're just locked into that payoff. You know what you know, it's good risk reward, but you need the market to not only go to 2000, you need it to stay there. You need it to stay there or above there by the time of your expiry for you actually to cash in the money, right? And that's something that, go on.
But are we assuming that we already have a position in gold? And that's why we are looking at the options, because the options only come into the picture to amplify the positions that we already have. So I'm assuming that we already have a solid position in gold, and on top of that, we are getting a call spread.
Not necessarily. I didn't specify that at the start. I mean, some people like to trade like that, for sure. Some people like to use options as like the final layer of extra momentum to capture something that's happening, right?
Yeah,
but
yeah.
that's not a given. That's definitely not a given. Yeah.
So, but say for example, then something like a call spread, when I'm right, I'm making say $75. Isn't a huge bit of deal if I'm making $75 in 3 months. So why would anyone just play on options, even though they have say something like 1,000 options in their portfolio? Why would it seem attractive to me just buying options alone? Because even if I'm right, I'm not getting the whole value out of it.
Because the protection you're getting on the downside. So if gold goes to 1,400 and you're long delta.
But you said that we are assuming that the gold is going to go to 2,000.
No, I'm not assuming anything. I'm saying if our target, you can't assume anything, right, about markets or trading, right? All you can do is conjecture, right? All you can do is have a view and have a scenario that you think is realistic and makes sense, and you can apply logic and narrative and whatever you want to do, charts, technical analysis. You can decide what you think is the most likely scenario. But if you don't respect the scenario that you're wrong, you will die, right? As in, the market will kill you on a regular basis.
But that has to be like 70-30. If I believe that something's going to happen, I have to back it by a 70% conviction, and I have to protect it by a 30% conviction, right? So for me, my entire portfolio, if you look at it in that sense, options would be, let's say, 30%, and the exposure to gold would be at 70%. So is there something wrong in having something like this as opposed to say 100% option based portfolio?
No, I'm not advocating 100% options based portfolio at all. What I'm saying, I'm just showing you what the option payoffs look like and what scenarios they give you, and you can determine how much money you want to play with in the options side versus the Delta One side. Like me personally, the way I look at it is I think of the Delta One money as more long-term money, basically, right? So I try to, there's certainly in gold, for example, right? For me, gold is a long-term play. It's going to the moon over time. Fundamentals of it are too strong. And I'm very comfortable holding a large amount of Delta One exposure in my pension pot in gold. Okay. Right. And I don't, if it goes down a lot, I won't feel the need to stop out, right? Because I've allocated whatever percentage of my pot to gold, and I see that as protecting me against a lot of scenarios, and I want to have it in there, basically. Okay. That's different to having a tactical 2-month view that gold's got 200 points to rally in the next 2 months, right? That's all about timing. That's tactical. That might be chart driven. That might be, momentum driven, whatever it is. But that's a very short-term trading tactical view. Now, you can trade that view in lots of different ways, right? You can trade that view using futures with a stop loss, right? Yeah. You can trade that view with options, right? But it's a short-term view, yeah? So I'm just trying to open your eyes to what the different ways of playing that view are in options, whether or not, how to think about the risk reward and the payoff structure of those things. And then on top of that, realize that those payoff structures can be dependent on time. So in the short-term move, that call spread won't give you all the returns that it's promising you unless we stay up there, right? Whereas the flip side of that is the low delta calls will give you all that payoff and more if the move comes quick. If the move comes too slowly, they'll never make you a bean, basically, right? Yeah. So it's just understanding what your different scenarios are for the different structures that you could trade, And then it's up to you how you do it, right? It's up to you which one you like. It's a bit touchy-feely, right? Only through experience and trying it and observing it will you get a feel for which structures are best to your type of trading. If you're a super active trader who likes to get in and out of positions like on a daily basis or a weekly basis, you'll probably prefer Alex's style of trade because you want to be able to monetize it quickly if it's right, yeah? Whereas if you're a more passive kind of person who's like, I want to stick the trade on, I don't want to have to worry about it, and I want to look back at it in a month and see where it is, yeah? Then the call spread probably works better because you don't care to monetize the move instantly because you get a 5% up day in gold or whatever, right? You're playing it much more passive, much more medium-term type trading, yeah? So different structures are going to be suitable for different trading styles. And, you know, it's your job to understand what all the different structures are that you could use, how they behave, what their properties are, and then determine which style suits you best. Yeah? Make sense?
Yeah.
Okay. So that I just thought that would be a good exercise to learn what we learned yesterday and put it into the context of something that everyone's got their eyes on right now, like gold. Yeah. But you know what? I don't mind it. I don't mind the call spread. It's all right. Because, like I said, the risk reward is decent. 2 months is a big enough amount of time for it to potentially get there. Like I said, I think we're going to get more stimulus and more support going into the elections. So it probably is an okay trade, right? And if I'm honest, I feel like the way the gold's been trading, I'm probably a bit more comfortable in the call spread than I am in the low delta calls that Alex suggested, just because I'm not as convinced that the move happens so fast and so aggressively. Like silver's obviously had a super aggressive move. So had you done those low delta calls in silver, you'd be laughing right now. 10% in 2 days. I mean, it's nuts, right? And I'm sure the vols exploded. In fact, we can look. Let me bring up a silver call option, and you can see just how much it's made. Yeah. And you know, you guys can do this for yourself, right? Like, what if you have an account on one of these platforms? You know, you can monitor these options and what they're doing to get a better feel for what you can achieve, right? So if you look at silver, I mean, we won't go 28th of July. Where is it? 17th of August is probably an okay one, right? So if we have a look at what the calls did, something like a 2,500 call, let's say, right? Let me add that to the workspace. So give me a guess. What do you think the 2,500 call, which is currently worth 65, what do you think it was worth 3 days ago? Just guess. It's worth 65 right now.
20.
Around half, 30-ish.
So you think they've only doubled in value? So silver had a 10% rally in 2 days. And you think that call option that was 25, right? Which 2 days ago, when silver was trading at 18, was like 30% out of the money option with a month to go. You think it's only doubled in value? That seems a bit nuts to me. I'd be shocked if it wasn't worth 10 or less. Yeah. So let's have a look. I've got a chart for it here. Right. Boom. Right, so on the 20th of July, at the start of the week, it was worth 6. Now it's worth 65. Right? And you think it's doubled in value? Come on, guys. Think. Yeah? It's done 10 times your money in 2 days. Yeah? 3 days. So the Alex trade, I'm calling it the Alex trade now, right? That trade that Alex suggested in gold is exactly that trade, right? It's a 1 month way out of the money low delta option. You've just had an aggressive move. And the reason why that's gone up so much is because the vol has probably gone up massively, right? Silver vol is trading at 60 now. It was probably trading at 30 or 40 before this move. So not only have you had all the benefit from the spot price move, but the implied vol has doubled or done something crazy, right? And that's why those options are worth so much more than they were, yeah? So the sheer, and actually the highs in this option were 90, bloody hell, 97, yeah? That was earlier today, it was worth 97, that option. And you could have bought that, for 5. You could have bought that for 5 on Monday, on the close on Monday, right? That's pretty crazy, right? So yeah, that just shows you, having a few of these little lottery tickets every now and again in the book can do you some wonders, yeah? So,
especially when you're buying at 5, right? Because, I mean, worst case scenario, it goes to 0.
Yeah, but that's the point. You don't have to spend, the point is you don't have to spend a lot of money.
Yeah.
So, let's say your risk budget for a trade, like you might have this bullish view on silver or gold or whatever. And you might say, look, I'm willing to lose £500 on this view. Okay. So what probably a smart thing to do is to say, well, let's put 10% of that, so £50 of that, into a super high octane crazy thing like that call that might make 10 times its money, yeah? And then let's put the rest in a call spread, or put some of it in a call spread and then put some of it in just straight futures with a stop loss or whatever it is. But there's nothing to stop you chopping up your implementation of a trade into a few different components, because you don't know what scenario is going to play out, right? So this kind of diversifies your implementation, yeah, of the same view, but it can play out in so many different ways that you get exposure to those different ways, right? And you'll be happy you did that had you done it in silver, right? Because it's done, like say, went from 5 to 60, but actually at one point it was worth nearly 100, right? And I'm pretty sure you'd be banging it out quite happily. I mean, the fact that it gapped, right? It went from last night, it was at 20, and then it gapped open at like 70, right? So that gap, you didn't even have a chance to like get rid of it at 50, right? It went from 20 to 70 by itself, yeah? Which is quite amazing.
This morning.
Because normally what would happen is you'd buy it for 5, it would go to 25, you'd sell it, and then it'd go to 100, and you'd be annoyed with yourself, right? This didn't even give you the chance to do that, right? So pretty amazing. Amazing. All right.